Hey everyone, welcome to a new video. Today we'll look at how the biggest markets are developing, specifically the American markets. I'll go through all the important data with you and show you when certain developments might occur. It's going to be particularly interesting with the S&P 500 and Russell 2000. Many people don't have Russell 2000 on their radar, but for traders, this could be a huge opportunity. Let's start with an interesting statistic from Statista. The probability of a recession has increased significantly for 2025. This doesn't necessarily mean a recession will happen, but market participants are expecting it, and that will impact the markets. By the way, a few weeks ago I made a video about NASDAQ where I discussed a possible 30% crash. Feel free to check it out after this video. An important point is Nvidia. Currently the most valuable company in the world has an enormous influence on the major indices. In the S&P 500, 20% of performance is attributable to Nvidia alone. For comparison, the second largest company only contributes 3% to growth. Looking at the Magnificent Seven, they already make up 50 to 60% of total performance. This isn't sustainable and could change in the coming correction phase. Let's talk about interest rates. The recent rate cuts were positive and expected. 50 basis points 2 months ago. Recently, another 25. However, what's interesting are mortgage rates, an important early indicator for recessions. These are at 7% and could even rise to 8%. That would be critical and could lead to increased loan defaults, which would heavily burden banks. The economy is currently growing at 4%, which sounds good at first glance. However, this could fuel inflation again. Not a good development in the medium term. In my opinion, the Fed declared victory over inflation too early. A warning sign. Youth unemployment is at 9.5%, the highest value since August 2021. Plus, there are 1 million fewer jobs than a year ago. Particularly concerning is the risk of stagflation. The wage increases of recent years have been completely eaten up by rising living costs. This is particularly evident in the inflation data. The 1-month PCE inflation is at 4%, while the 3-month is at 2%. The comparison with 1975/76 is interesting. Back then, inflation fell from 12% to 4% within a year, very similar to today. I expect this cycle to repeat. My personal assessment: we won't see very low inflation rates in the next 10 years, but definitely do your own research. Another risk factor is retail investors. They're striving for ever higher returns, but aren't achieving them. This could lead to selling pressure. Looking at the 10-year Treasury yields, they're currently at a peak similar to 1929 and 1975. While I don't expect a 1929-style recession, something comparable to 1975 is possible. That would mean higher inflation and falling markets. In every major recession, whether 2000 or 1975, U.S. interest rates rose by about 5% beforehand. The situation is particularly critical for small businesses, the backbone of the economy. 20% of them have recorded a significant decline in revenue over the last 3 months. This further weakens consumption. Many analysts see a recession coming for 2025 because the Fed has no choice but to cut rates. There are 2 possible scenarios. Rapid rate cuts. This could lead to the collapse of the yen carry trade. To explain, 2 to 3 months ago, when we saw this big sell-off, hardly any yen positions were unwound. Instead, most investors held their positions. If the Fed now cuts rates too quickly to 1 to 2%, this carry trade would collapse. This would be extremely critical for the markets. Slow rate cuts. The Fed seems to prefer this approach. This would mean the bubble would more likely burst in the U.S. commercial real estate sector, which would be easier for the Fed to handle than a crisis caused by a collapsing yen carry trade. Historically, there has been at least a 30% sell-off in all 5 recessions. That's something to keep in mind. Let's move on to the Russell 2000, which is particularly exciting right now. My target zone is between 2,320 and 2,500. I'm currently short positioned, but have my stop loss not at 2,500, but at 2,700. This allows me to short the market without being too heavily leveraged. From today's perspective, this means a risk of 16%. For more cautious traders, I also have positions with stop loss at 2,500. This corresponds to a risk of 4.4%. Everyone needs to decide for themselves where to short. An important note for ETF savings plans on the Russell: check if you're not too heavily invested. If you got in during 2022 or 2024, you're sitting on a 46% gain. That's pretty good for such a short time. If you can live with being maybe 20% down in a year or two, you can keep the savings plan running. For me personally, that's not enough. My goal is to outperform the market. That's why I analyze individual stocks and markets so carefully. Now to my concrete trading strategy. For me to become bullish on Russell 2000, it would need to rise above 2,775. I don't see that happening right now. For short traders, the marks between 2,320 and 2,500 are extremely important. If this target zone is broken, the next interesting short entry zones would be at 2,600 and 2,776. However, I don't think we'll reach 2,600. The market structure and sentiment don't support that. For short traders with a risk of 4.5%, calculate for yourself what you're comfortable with. In a sell-off, the correction could last 1 to 2 years with losses of 46 to 50%. Let's move on to the S&P 500, which probably many of you have been waiting for. By the way, if you like the video, please leave a like and subscribe to the channel. I'm positioned here short to medium term. There's an exciting short zone for traders with a very attractive risk-reward ratio. The risk is only 1.12%, with a profit potential of at least 8.85% up to 15%. This could be very profitable for traders using higher leverage. My stop loss is at the all-time highs. If those are broken, I would become bullish in the medium term before the big sell-off comes. Long-term, meaning for 2025, I'm actually bullish on the S&P 500. For normal investors who want to stay invested for a few weeks to months, a long ETF or long options could be quite profitable in the medium term. 20 to 30% is definitely possible. Looking at a 5-year horizon, I expect S&P 500 levels between 6,500 and 11,000. The wide range is explained by the difficulty of making predictions over such long periods. That's it for today. If this video helped you, I'd appreciate a thumbs up. See you next time.